what do investors really want to see, right? What they care about is scale, they care about growth, they care about profitability, they care about predictability, and they care about durability. And this CEO's like, okay, that makes sense. And he's like, ooh, predictability.
Going public is one of the most critical and complex moments in a private company's growth journey. Today, we will explore the IPO journey through the experiences and perspectives of leading banking advisors and investors. Welcome to Season 2 of Crafting Capital, the podcast that takes you inside the rapidly evolving world of private markets. Gregor, Mike, thanks for joining me.
Thanks for having us, Rocky.
Yeah, thank you.
Can we first set the scene, Gregor? The IPO market has recently started to pick up pace after a slow start to the year, right? Can you talk us through what has been sort of driving this uptick in new issuance?
It's interesting. If you sort of think about the start of the year, there's always that sort of uncertainty when you have a new administration coming in. So if you look at the first few months of the year, you have a little bit slower activity. So about 16 IPOs before Liberation Day. Then everything shut down for basically the month of April. It was like, all right, we have no idea what's going to happen. And then everything kind of rallied and people feeling very good about it. So over the last few months, you've actually had 26 IPOs that have happened. So we're kind of at 42 for the year and $22 billion raised. So you're really seeing that resurgence. Early in the year, it was mostly healthcare and industrials. But what we've seen on the most recent months is really tech and digital assets being sort of the center of what we're seeing. And what that means is you've got a risk-on attitude. Growth is in favor and IPOs are coming. And there's a diversity to what we're seeing in IPOs. There's large profitable companies, large not profitable companies, small companies, like really all of what you'd want to see in a healthy IPO market. So we expect the back half of the year to be really active from that point of view.
And Mike, from your perspective, why have companies chosen to stay private for longer and delay their IPO? And do you expect this trend to change now that the market's opening up?
I think the main reason is it's never been easier to stay private given the depth of capital available to companies in private markets. Insight Partners Public Equities, or IPE, we offer flexible capital solutions to companies across public and private markets. Late-stage private market activity remains extremely elevated. We saw IPE portfolio company Databricks just announced that they're seeking a Series K financing. And I think that's indicative of the momentum you see in private markets. Now, many of the companies that are choosing to stay private have the attributes that would allow them to go public tomorrow if they wanted to. They have scale, good growth opportunities ahead of them, strong product market fit. So I think that that's setting the table for strong IPO activity in the years to come as those companies eventually seek to go public.
You know, Series K used to be known as the third follow-on as a public company. So that's the kind of amazing transition that we've seen in the financing world from an equity point of view.
Gregor, there's over 1,000, right, private companies who've reached sort of unicorn status, which are those valued obviously at $1 billion or more. How would this shape the IPO pipeline, do you think?
So if you kind of rewind the clock to 2013, Eileen Lee famously kind of came up and coined the term unicorn. And so guess how many private unicorns, Mike, there were in 2013? Private, not public ones that had gone public, but she was kind of looking at the past decade. So how many private unicorns?
15.
He's good. See, this is why we brought him on. This is why we brought him on. It was 16, so he was wrong, but he took the under, which was a good move.
Close.
That's a pretty.
Price is right.
The price is right. You're feeling pretty good about that action. So you go from that, and now we've got about 1,300. So let's just sort of say you've got 1,250 because it's easier math, right? So you probably have 250 of these companies that are going to be natural public companies. Maybe they get acquired. Obviously Figma people tried to acquire and then it didn't happen and ultimately went public. And then you probably have 250 of these companies that really are going to go away, right? They're not really going to be viable businesses. So you have this sort of, area in the middle, call it 750 companies that probably can't go public. They don't have the scale to go public. They're not, profitable. They're not growing enough and they're going to have to sort of combine. But that 250 is what you're going to see come into the public markets. And normally you'd see, plus or minus kind of 50 IPOs in the kind of growth asset class. So, that's going to take a few years to digest, but we expect larger companies and really more scaled and growthy companies that are going to come out, and really where you want to see the IPO market is focusing on that kind of 250 names.
Mike, what's your take on this? Are there other paths to liquidity beyond IPOs?
Yeah, I think there's multiple paths to liquidity beyond the IPO market, and M&A in particular can be a great outcome for both companies and investors. In 2024, Insight saw over $8 billion of realizations from portfolio company sales through M&A. Companies like Recorded Future to MasterCard or owned to Salesforce. And we've seen that momentum continue into 2025. IPP's portfolio company Wiz announced a $32 billion sale to Google earlier this year. So I think whether it's the IPO market, which is wide open today, a vibrant late-stage private market, or an active M&A market, there's a lot of options available to companies today.
I don't think I've been in a single boardroom where when you ask sort of on that dual track process, right, IPO or M&A, everyone's like, well, we'd prefer M&A, right? We'd prefer to kind of take the chips off the table and kind of move things forward, move the monetization forward. But the reality is, a lot of companies and the way that they scale as independent public companies is where massive value creation takes place.
So Gregor, as interest in public listings is certainly picking up, from your experience, what should be the sort of first step private companies should take when considering an IPO? And what does that prep timeline look like?
So what do you focus on is focus on delivering for your customer. That's the kind of core principle. And that's the rest of it will lead from there, right? Preparing, getting your sort of internal controls in place, working with the CFO over time, engaging with investors like Mike. That's all part of it, but really thinking about it as a 2-year process towards IPO. And what I say to companies is, think about that 6-month window in which you want to be prepared to be a public company. You may not go public. I had one client who desperately wanted to go public on the 17th of April. And I was like, okay, why? Well, it was his birthday. So it was very important, but it was a Saturday. So it wasn't going to happen for him unless he wanted to wait a few years to go public. And so finding that sort of right sweet spot, putting in place all of the principles that you're going to see and need as a public company, the predictability you need, the ability to close your quarter, and I think, most importantly, cultivating those relationships over 18 months, whether it's through conferences or going and doing non-deal roadshows, cultivating those investor relationships is a really critical part of finding success.
Mike, similar question for you. How early in the IPO journey do you think companies should be engaging with investors, and why is that important?
I think the best way to earn investor attention at your IPO is to start building a relationship long before your IPO goes on file. And Gregor was right to point out doing non-deal roadshows and conferences and testing the waters meetings is a great way to get attention from investors and let us learn your story and understand your business and watch how you make decisions in the year or so leading up to your IPO. At Insight, we work with our portfolio companies in the build up to an IPO to focus on what are the key business value drivers for you? How do you translate those into clear, reportable metrics? And then ultimately, your success in public markets will be driven by setting realistic expectations, consistently exceeding them, and that's how you build trust with investors over time.
I was in a meeting with a founder and CEO of an AI adjacent company, sort of infrastructure for AI. And I was going through what you sort of need to have, whether it's for private investing or public investing. What do investors really want to see, right? What they care about is scale. They care about growth. They care about profitability. They care about predictability, and they care about durability. And this CEO is like, okay, that makes sense. And he's like, ooh, predictability. Right? If you're an AI company and you have the kind of growth that you're doing, and it was funny because he's talking about going public sort of sooner rather than later, which I would encourage all companies to be considering it. The IPO market is open, particularly if you're in the digital asset space or anything adjacent to AI. But predictability is really difficult when you're seeing that kind of growth. At the end of the day, investors care most and they pay most for growth. Profitability will come in time, but that predictability is how you sort of push yourself up into a much more sort of durable, elevated multiple relative to your comparable companies.
Mike, anything to add here?
Yeah, I think one of the biggest differences we see when we talk to our private companies is the types of conversations you have with public market investors tend to be a lot more direct than conversations you might have in private markets where people are trying to curry favor with the company to get into a deal, and public market investors tend to be a lot more skeptical and direct. So the line of questioning can be a bit of a surprise at first and refreshing to companies to have a really active, well-informed dialogue with public market investors, but can certainly be a different tone.
The other thing I think that's important with this is you kind of go through the IPO process. You draft your S1, right? Your prospectus. You kind of spend all this time, and the number of companies that view that first with sort of a little bit of hesitancy. They're wondering what's going to, but they learn so much about what their company looks like. And one other thing I always say, I've said, focus on customers first, right? But you're talking to investors, it is a different sales motion, right? You're not doing the same thing. When you're selling to Mike, you have a different story that you're looking to tell. And I think going through that process is very sort of clarifying for a lot of companies. You think about the vision, what are the sort of breadcrumbs you want to lay for what's going to kind of come next for your business? And I think it's a very healthy thing. Companies that become public companies, there's a lot of discipline that's enforced by those hedge fund managers who ask very, very direct questions.
Mike, on that note, what are investors looking for then in companies coming to the public market, particularly regarding the sort of growing importance of AI?
Yeah, I think the most important topic for any company looking to go public today is having a clear narrative around how AI impacts their business and why is it a bigger opportunity than a risk for you. And that means communicating how AI improves your product or your cost structure, and importantly, why is that sustainable? Do you have proprietary data or unique distribution that advantages your product? And when we're evaluating IPOs, we do it the same process as when we evaluate any investment. And that starts with assessing a company's competitive advantage and the durability of their moat. And the strength of a company's moat is particularly important in AI, as it's going to dictate the extent to which you retain AI-driven efficiencies or ultimately see them competed away.
Gregor, you talked about value earlier. I wanted to ask you this question. In today's market, is value driven more by profitability or by growth?
Growth. Right? It's very simple. Right? 2022, after the sort of, the punch bowl being overflowing in 2020 and 21 in the ZERP environment, you had this sort of car crash of 2022, and everyone's saying this is all about profitability. And I think, famously, Meta, kind of went down and really sort of turned the screws on profitability. So that was the focus then. Now it's shifted very much back towards growth, and that started in 23 and 24 as sort of people got out of the coma post 2021. And so what we're seeing now is growth is what drives valuation. Profitability and predictability are what allow you to sort of push up relative to others, but really binary in terms of scale, right? If you're a scaled business that's growing 20% plus, I always like to say that, in the current environment, 30 is the new 40, 20 is the new 30, right? 10 is the new 20. And so you're seeing all of these businesses calibrate towards good growth, right? There's good calories and there's bad calories. There's good growth and there's bad growth. And I think that companies now are viewing the way that they grow and the fact that it's sustainable and durable growth really being a focus from investors.
So Gregor, then when it comes to a successful IPO, is it sort of measured by like the pop on day one where the stocks trade up? Or are you looking at sort of a more long-term value creation as the best measure of success?
So for each company, the measure of success is different, right? They're all solving for different things when they ultimately go public. Some companies want the pop. Some companies don't want the pop. Some people are focused on the valuation at the time of IPO. Others are focused on how much secondary can we sell, right? So really IPOs kind of come down to a handful of factors. One is timing, which we talked about before, right? That you can broadly control, right? Deciding what that 6-month window. You can't control the market conditions during that 6-month window. You really need to sort of just run the business to run the business, and you need to shift around, that's fine. The size of the IPO that you want to do, how much primary capital do you need to run the business and grow the business over the course of the next 18 months? How much secondary you need to sell for existing investors? Valuation's one part of it, right? And it's an important part of it, but that's really the start of a long journey as a public company. It's sort of the end of the beginning, we like to say, for businesses. And then the other piece of it is the quality of investors. And I would argue that the quality of investors is the most critical amongst all of those. Now, what's interesting is you've got Series K happening for the likes of Databricks. So a lot of crossover investors like an Insight are coming in early and then growing with these companies over time. But finding those large mutual fund managers that really get it and are going to grow with you from a $10 billion company to a $100 billion company. It's not so many $1 trillion companies, but if you told me we'd be talking about $1 trillion companies, I'd be pretty surprised. And now we've got multi-trillion dollar companies. It's happening very, very rapidly. But that value creation in both the late stage private market and in the public markets is great to see.
Mike, last question for you. What does a successful IPO look like to you?
Yeah, so an IPO is just one important step on a company's journey, but it's not the destination. And your ultimate success in public markets will be driven by how your business performs and how you execute in the coming quarters and years, not by IPO headlines or short-term trading dynamics. So for us, a successful IPO is, did you raise the capital you need for your business and build a cap table of long-term oriented shareholders who can support you and guide you through public markets in the years to come?
And so you look at a company like Figma, which just went public, stock's up 150%. They were going to sell the business for $20 billion, and now it's worth $35-40 billion. Now, was that pop a success, not a success? If I'm an employee, I'm feeling pretty good about the fact that we didn't sell at $20 billion, and now I'm potentially going to be able to monetize at much meaningfully higher levels. So it really does kind of come down to that. And having investors that want to be with you for the long term, right, who are thinking about annual results as opposed to quarterly results, those are the partners that you at the end of the day want to have. And that's why I really focus on the quality of investors at the end of the day.
Mike, Gregor, thank you.
Great to be with you. Thank you.
Yeah, thanks for having us.
From that first decision to list, to managing investor expectations and navigating post-IPO scrutiny, going public is not for the faint of heart. But when done successfully, there are huge rewards, from public market credibility to long-term value creation. You've been listening to Crafting Capital, a podcast series in partnership with custom content from the Wall Street Journal and UBS. I've been your host, Rocky Merchandani. Join us for more episodes at partners.wsj.com/UBS, and be sure to subscribe on Spotify and Apple Podcasts. The content in this podcast was relevant when published on 22nd September 2025. Current views may differ.